Thank you for tuning into the Equity Channel, where we provide the highest quality stock market analysis to individual investors. Our goal is to help you improve your returns while keeping you up to date with everything that you need to know. What helps investors beat the market is information and knowledge of how to use it. We'll provide you with both. Before we get started, be sure that you subscribe and turn on your notifications, because every time we drop a new episode, money is made. Okay. Today we're going to be talking about systematic approaches to investing versus qualitative approaches to investing. Now, this is not going to be a very long presentation. We're going to spend more of our time actually digging into the application of a systematic approach. All right. Now, today our focus is on the magic formula by Joel Greenblatt, one of the most important value investing strategies of all time. This strategy was written into a little book that beats the market, one of my favorite books. This particular strategy involved looking for stocks that were essentially offering a high yield along with a reasonable return. We'll get more into that in a few. Let's dig into it. So, systematic versus qualitative value investing strategies. All right. And we're going from the magic formula to the guided alpha model, where we'll discuss how the guided alpha model tweaked the magic formula just a little bit. We didn't do too much, but we tweaked it just a tiny bit. All right. I'm going to break this all down for you right here, right now. Let's talk about it. So, two paths to discovery. Qualitative approach. This involves, more human judgment, right? You're assessing the competitive advantages of a company, the management quality, the macroeconomic narratives, right? It's a highly subjective, heavily dependent on the analyst's experience and intuition. And so, this is more of the approach of a Warren Buffett. So he digs into all the qualitative factors, and then he says, great, I like the company, is it cheap or not? Right? Then you have more of the systematic approach, right? You just really dropping companies into a system, or dropping a universe of stocks into a system and going, right? I see this, 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 I see this. Right? So this is a predefined mathematical rules-based algorithms that identify mispriced securities. And it strips away emotion. It relies on rigorous backtesting and exploits consistent behavioral market anomalies. Now, what's very interesting about these particular approaches here, right? What's very interesting about these particular approaches is that when we say algorithm, people automatically think machines, right? But an algorithm doesn't always have to be a machine. An algorithm is more a way of getting something done in a very systematic fashion, right? Like, we just have machines that tend to run algorithmic processes a lot better, right? And you may be one of the ones who, when you heard the algorithm, you immediately thought, "Oh, all right, it's a computer system, it's a program." I'm going to be asking you to challenge that thought in your mind today as I show you how to work the magic formula by hand. All right, let's dig into this now. The challenge of qualitative value is the human element is flawed. All right, the traditional value investing often fell victim to very cognitive biases as it attempted to, you know, exploit cognitive biases in other people. All right, so you're seeking information that supports a pre-existing thesis on a stock while ignoring contradictory data. That's confirmation bias. All right, and there's also the narrative fallacy, which is where you're falling in love with a turnaround story rather than objectively looking at the deteriorating fundamentals, which we're going to talk about tonight as well. It's going to be very interesting to talk about that. You have the overconfidence that falls here as well. You believe that you can accurately predict complex macroeconomic futures or management behavior. And then you fall victim to value traps, which means you're holding on to structurally declining businesses out of emotional attachment to a cheap valuation. Um, then came Joel Greenblatt and the magic formula. All right. This was more of a systematic approach to buying good companies at a bargain price. So you had the Buffett approach, which was more focused on like your actual ability to tell whether or not you were looking at a good company, like, oh yeah, the management's doing that, the management's doing this. I see this quality in the management team. I see that quality in the management team. It was more, in that fashion that you can understand the business in that way. It's still important to understand the business, but over time, we began to realize that quality companies, right, good companies had certain things in common. We began to realize that if we combine this metric with this metric, you put those together, you began to realize that over time, those ideas tended to play out positively. You can expect a positive result. Right? So the magic formula philosophy was pretty simple. All right. He realized that complex financial models often underperform simple, robust rules. So his magic formula, right, just ignored the qualitative noise and focused entirely on two distinct variables to rank thousands of stocks. And I always love this approach, guys. I can't wait to talk to you guys about this tonight. Right? We do something similar in our approach. We'll get there. But by systematically buying a basket of the highest ranked stocks, the portfolio mathematically captures businesses that are simultaneously highly profitable and deeply discounted by the market. Right? And it's actually a combination in every sense of the word. Right? It's a combination in every way that you can think about it. It actually literally intertwines those two factors. So it's absolutely amazing. Now, the first question you're asking is it cheap? So to find out if a company is cheap, we look at its earnings yield. Think of this like if you bought the entire business today, paying off all its debts and keeping all of its cash, how much money would it make for you each year? A higher yield means the that you get more earnings for every dollar you spend. It's simple and it's a quick way to see if the price you're paying makes any sense. Right? Now, then you're asking, is it a good business? And for this, we use return on capital. Well, for this, Joel Greenblatt used return on capital. So he used earnings yield to see if it was cheap. He used return on capital to see if it was a good quality business. All right. So to find out if a business is good, we check its return on capital. This simply asks, how well does the company use its money to make more money? If a company uses the buildings, tools, and cash it needs to run the business and makes a large profit from them, it is a great business. A high return means the leaders are putting their money to work in a smart way. All right. And this is what things look like throughout the study. The market was giving you an average of 12.3, and the magic formula was giving you an average of 30.8. All right. And so this was the original back test, the magic formula, right? It was highly asymmetric annualized returns, proving that systematic value disciplines overcome behavioral market error over time. Right. Now, the reality ended up being that other people back tested this and they didn't get the same results. So they didn't get 30%, but they still managed to always beat the market. And I think that that's what matters. Okay. Now, moving on from there, all right, the evolution the evolution of this system, working its way towards the guided alpha model. So we kind of refined the formula for modern markets by eliminating accounting distortions. That's what we pretty much did. All right. So first things first. Um, we replaced EBIT with free cash flow. We replaced earnings with free cash flow. So operating earnings are susceptible to accounting, um, you know, like mispractices and things of that nature. And so we upgraded earnings yield to free cash flow yield. And this allowed us to track the actual cash a business generates. Now, I am going to show you tonight irrefutable evidence that free cash flow, free cash flow yield, and free price to free cash flow outperforms all other metrics. Okay. We took return on capital and moved that to return on invested capital. So standard return on capital ignores taxes and it ignores intangible assets. Okay. The model that we use, it shifts this towards a return on invested capital for a more comprehensive view of how management allocates all available capital. Also, return on invested capital seems to have a slight edge on return on capital as well. Now, so this we have this enhanced quality here. So by relying on cash rather than accounting accruals, and the model naturally filters out companies that could manipulate earnings, right? And that would reduce exposure to permanent capital loss, which is right the primary goal of value investing. All right. Now, The next thing here is, well, why free cash flow yield? And so the truth is in the cash. So as we said again, earnings yield relies on EBIT, which does not account for capital expenditures. So there's no capex eliminated from EBIT. A company might show high earnings while simultaneously bleeding cash to maintain its operations. A free cash flow yield, all right, which is pretty much free cash flow divided by the value of the business. This represents the unencumbered cash available to be distributed to shareholders via dividends, buybacks, or debt reduction. It's significantly harder for anybody to manipulate the cash register than the income statement. So I want you to imagine that I run a storefront, right? I want you to imagine that I have, um, imagine that I have, um, let's say, $10,000 in cash that's already in my register right now. Okay, that's the cash that came in. Stay with me now. Again, I want you to imagine that I have already $10,000 in cash in my register. That's already cash coming in. Now, I want you to imagine that I state that, well, I already booked $50,000 in earnings for the day. Now, while that's all fine and dandy here, the reality is that you can't verify that. You have to take my word for it. That I have 20,000 now, and by the end of the day, I'll have another 30. Okay? Now, I also want you to imagine that I have $30,000 in capex, bills, interest payments, taxes, all that good stuff. I have $30,000 in total that I have to pay by the end of the day. So if I don't get at least another 10,000 in the door, then I'll be insolvent. All right. If I don't get that full 50,000, I'm a lot worse off than I actually was because, well, in the end, if I only have enough just to pay my bills, then there's nothing left over for me to give to you. So that's the premise of you know when you're thinking about free cash flow. All right, we're thinking about I I actually have $50,000 in cash already, and I told you I had $40,000 booked for the day. Now I have this extra $10,000 in cash that you didn't even see coming, and on top of that, I only have $30,000 in bills. You see how different that story sounds now? Now you have excess cash. Now you're like, okay, cool. Now I know I got something coming my way. That's the story of free cash flow. You know you got something coming for you. So it looks a lot like this. You have accounting manipulation that can take place. You have capex that you have to focus on. You have working capital, right? This can be distorted by aggressive revenue recognition. Okay. If if I have, like I said, all of this, if I have all of this, all of these bills due, but I haven't actually gotten to the point yet where, but I haven't actually gotten to the point yet where how do I put it, where I've collected that money yet. It's going to show up on my balance sheet as accounts receivables, which is an asset, right? If if Rashawn told me that she was going to buy $10,000 in my top product in 1 month, then I can book that as $10,000 in accounts receivables. My balance sheet is now $10,000 richer, but my bank account is still $10,000 light of cash. So even the working capital on your balance sheet has to come into question when you're not dealing with actual cash. So we really want to be careful and be mindful of companies that can't really, present us with the cash that we're looking for. Now, um, then there's a predictive power of these things where earnings has some good predictive power. Don't get me wrong. Um, a high earnings yield, a high operating yield is a great predictor of future performance. But free cash flow, you can already tell based on everything that I'm saying to you right now, is just a superior predictor of future returns. Because I actually know literally that you have cash in your hand that you could give me if you wanted to. Imagine you were an investor who had to show up at my store at the end of the day and ask for your cut of the cash. Would you really be, what's the word I'm looking for? Would you really be okay with me just handing you a piece of paper and saying it's coming? Or would you only be comfortable if you walked in and I said, let's go to the back and count this cash that we got so far? I think we know which one everybody's going to be looking for. Everybody wants the option B. Y'all want to go to the back and count some cash. I know you do. I know you do. You want to go to the back, you want to count that cash, and you want to walk out with something right now and tell them I'll be back tomorrow. That's what you really want. Right? Now, the problem with standard return on capital, right, was that it looked only at tangible assets, right? So net working capital plus net fixed assets. And it fails to penalize companies in high tax brackets or those built via expensive acquisitions like goodwill and stuff like that, right? But also, as we said, as you can see here, right, it's the profit after taxes that we look at for return on invested capital. And then we're using the total debt and equity here, right? Total debt and equity. So we don't subtract the debt. We lean into that. So everything that was ever invested into the company, including the debt, what type of a return are we getting on that? That's just magical. All right. So historically, the top decile free cash flow yield and ROIC stocks generate a 3 to 5% annualized premium over 20 years, 15% to 10% compound annual growth rate creates a 2 times larger final portfolio due to exponential compounding. All right, meaning people who focus on free cash flow yield and return on invested capital tended to do better than people who focus on earnings yield and return of capital. All right. Also, a lot of times companies with high yields ended up being what they call falling knives. All right. So by demanding actual free cash flow, the model reduced bankruptcies and severe drawdowns by up to 40%. So this was something that you really wanted to lean into, which was the stronger companies by free cash flow, who were able to like see their investors paid back a lot earlier because they had paid back a lot earlier because they had they had stronger businesses fundamentally or at their core. They had stronger businesses. All right. So um, like I said, we're not going to do a lot of presentation work today. We're actually going to get into we're actually going to get into running an actual model here where I'm going to show you how this works. But before I do that, would anybody like to ask any questions? Maybe I'll answer a few questions before we or while I get ready to run the example. Any questions while I do that? Anyone? So Jerry?
I do have a question. Thanks a lot for the explanation.
No problem.
Maybe we should put things down. So in your case, right? So when you're looking for, from my understanding, is from what you explained, you seem to be more focused on value, right? Understanding the fundamental, right?
Yes, sir.
Am I correct on that? Okay. So one Buffett type of investor, right?
Well, I mean,
Charlie Munger.
not necessarily Buffett, but but value nonetheless. Talk to me.
Okay, value, good. So what I was asking essentially is like when you looking for companies in general, is there sort of like a filter that you apply? Do you just stay domestically, or you go no matter where the value is in terms of like just looking for pure value as opposed to the price that you pay for?
That's actually a really great question. Um, it does matter where. There are times when I want to have a global portfolio. There are times when I don't want to have a global portfolio. There are times when I would actually prefer to to have a more localized portfolio that's more based in the United States. So yeah, I'm not always going to be looking to expand that way. Sometimes I'm looking for stocks in specific sectors. So sometimes I'm looking specifically for the companies in industrials if I feel like we're coming out of an economic downturn, or sometimes I'm looking for companies in the tech sector if I feel like we're already in the midst of you know a nice expansion in the economy, that kind of thing. So I could be looking at different. I could be looking at different. That's what I'm looking for. I could be looking at
Momentum.
different categories or different sectors. Those types of things at different points in time. So
No, that's good to hear.
yeah,
Thanks.
no problem. Yeah. It's never going to be static. By the way, I actually am about to show you one of the processes that's involved in my system. Um, if you want, you can click the link at the top of the room. You'll see it says "Watch us on Twitch." I'm about to do this live right now and show you one of the systems that it's from a guy by the name of Joel Greenblatt. So that's why I said, yeah, that's why I said not necessarily Buffett. I don't think I look at him specifically. He's not even my favorite investor, even though I'm a value investor. So I know a lot of value investors say that's their favorite, right? That's their guy. For me, no, I was gonna say for me, I'm Peter Lynch. Talk to me.
Yeah, no, like Peter Lynch. To be honest, I read but my model was geared after Buffett and Charlie Munger.
Yeah.
Also, like I think it was the guy named Howard Marks. Also,
Yes. Yes.
there's another guy, Joel Blatt. Also, I look him up as well. Those are like some of the guys that I sort of like read their books. But one fundamental thing that I really understand from what they were saying is that price is what you pay, value is what you get, right?
Mm-hmm.
For example, like in my case, is like when I'm analyzing companies, I started off with the balance sheet, right? Because it's sort of like it's hard to hide things there, right?
Mm-hmm.
I would look at the asset relative to the liability. That part is very, very, very important. I would look at the working capital. I would sort of like assess to see if the company has any free cash flow. Those things are very, very important. Current asset and all of that kind of stuff. Return on asset. Those are like pretty good numbers for me.
Mm-hmm.
Once I sort of like have a sense of where that is, because essentially is that another number that I value a lot is the book value. Okay,
Mm-hmm.
because I want to make sure that if I'm investing my money in the company already has money in case the price goes down, that the company has enough assets where even if it faces a very very tough time, the fact that it has enough cash, it can sort of like weather the storm, right? That's the kind of stuff that I look for. And also like a low PE usually helps. If that makes sense, I'm not gonna lie to you. And but the more free cash flow that the company has, from my understanding, from the model that I have been using lately, the happier that I am. And then the next phase is gonna be try to understand the company, right? And also try to understand the industry in which the company is in. You know, does it have a competitive advantage? You know, is the company going to be able to sort of like increase the price of their services without having to face any reduction in customer servicing, right? Because you know, either they can increase the prices of the goods and services they are offering to increase revenue, but sometimes it has also some sort of like impact. So those things are somewhat important to me.
Yes.
But in looking at those, another thing that I do find, and I do that is that uh, you tend to find if you're looking for value in general, um, I tend to find more company outside of the US, not in terms of prospect, in terms of their future, but more so on the low PE, if that makes
Yeah.
sense. But
The
again,
value, valuation multiples.
right. But also there's a caveat to that one because there's a value trap there, which you explain in your one. You know, I picked a book on that subject, which was somewhat pretty interesting,
Mm-hmm.
saying essentially that a company might be very cheap, right, relative to the PE, to the cash that it has, but the company is not growing. Does that make sense?
Yeah. Of course.
That's a massive problem. You thinking that oh, because you are a value investor, you know, just because the company is cheap, it has a lot of cash. Another thing that I also look at for is does the company dilute the shareholders' value? When it has capital, does it reinvest in the company? That's number one, or does it return some of that money back to the shareholders if it knows that it cannot get a return higher than the cost of capital? So
Yes.
those are some of those things that I sort of like learn and read, and I'm still applying, but it is challenging.
Yeah.
But that's about it.
Definitely. I mean, you to me, you sound like you got a really great handle on things, and that's um that's a lot of what we discuss here as well. Like I said, so I'm actually about to go through a certain process right now. So stick around. Um, kind of tap in and tune into it. But I like everything that you had to say there, man. Those are great things to be on the lookout for when you're looking for great companies. And that's one of the things. That's one of the reasons we're talking qualitative versus systematic here tonight, because, like you said, like a lot of times, what happened was it was more those qualitative factors that maybe were the hidden issues behind behind things. And so over time, I began to realize that what was more important was to get to the point of having the best positive expectancy based on the quality of the business. And, once I get an understanding of the company and if I actually want to invest in them, right, then that can be a decision I can make solely on those premises and not have to focus so much on, like I don't know what the management. I don't know what the manager's going to do tomorrow. I don't know what the CEO is going to do tomorrow. I have no
That's
idea.
true.
Right? Like he can be the best guy. He could have just won the New York Times Man of the Year, right?
Right.
And then tomorrow he does the craziest thing. So those are some of the things. So like, again, keep in mind, I like Buffett, love Munger. Um, my style is more a merger of everybody, though, is all I'm saying, right? Because I saw things in so many different investors, that was, something for me to lean into. Now, okay. So guys, I'm about to start this screening process. So let me break this down for you guys. Let me break this down for you here, right? What Joel Greenblatt did, right, was he ranked the company. So you see, I started a blank sheet here. I started a blank sheet here, right? He ranked the companies. So we're gonna have the ticker symbol. Okay. We're going to have the let's go with the current price. Let's go with the let's go with the analyst target here. Let's go with then the ROIC ranking. Okay. The ROIC ranking. And let's go with the price to free cash flow ranking. So how his system worked, right? And I meant to put ranking there. How his system worked was pretty simple. He would simply say, I'm going to look at the position of the company and how they rank as far as being the best of the best in a universe of stocks. Now, for him, he could look at all stocks in the S&P 500 or the Nasdaq 100 or all stocks across the market. Period. For us, what do? You guys know we don't just follow blindly, right? We have a mind of our own. So what we do here is, as usual, we start with our basic filter. So who can tell me what some of the things in our basic screener to start off is? Anyone? What are some of the basic things in our base filter, base screener? Make sure the company is profitable. Make sure they're profitable, right? That's number one. So you click PE right here and you put profitable. Boom. Um no RIC in the base screener, Prince. That comes afterwards. So that it is involved, but it's not in the base screener. All right. The next thing I want to know is that the company's growing. All right. So I go earnings growth. This year, I want that to be positive. Earnings growth over the past 5 years, I want that to be positive. Sales growth over the past 5 years, I want that to be positive. All right. Now, the price to free cash flow, I'm going to set a limit on the price to free cash flow. Right now, because I'm doing a screener for a different purpose, I'm going to put price to free cash flow under 50. So that means I have at least a minimum of a 2% free cash flow yield. Okay. From here, we go to the financials where you can see return on invested capital right here. We're going to sort these companies out by return on invested capital. We want the highest return on invested capital first. Now, let me break this down for you guys how this works. All right. You see this list of companies here that have the highest return on invested capital in the group? What we do, right? I'm just going to use these first 20 companies as an example. I'm going to use them as an example here. Here's how this is going to work. Now, but typically we would rank this entire universe. I repeat, typically we would rank this entire universe. But we're gonna keep it simple so that way we don't have to do too much here. Okay. So we have WINA. I'm just going to write these down because I don't want to have to come back and forth to the page. Okay. And matter of fact, we're gonna keep it even more simple. Let's just go ticker symbol ROIC, price free cash flow, because we didn't need the analyst target just yet. We'll come back around to that. Okay. So WINA, FTNT, Otis, BKNG, MANH, NVIDIA, UI, Apple, MasterCard. Okay, so we're gonna go with these first 10 companies here. All right, so these companies, these are the 10 highest return on invested capital companies in the market. All right, that are also profitable, um, and have been growing their businesses. Okay, so oh, you know what? Hold on, I might as well just grab the return on invested capital at the same time. So that is a 256.07. That is a 131.48. That is a 92.62. That is a 85.42, 83.06, 77.17, 74.88, 67.76, and A is 65.06, and 63.89. Now, I'm writing the return on invested capital down only so we know what it was. But how we're actually gonna handle this is we're gonna rank the companies here on the list. So we're gonna go. So this is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Okay. So pretty much, what we're looking at here is what did the company rank in return on invested capital? Okay. Mm, what did the company rank in return on invested capital? You start with that. So WMA was the highest return on invested capital in the entire stock universe that we're looking at currently. Now, the next thing we need to do is we need to find these stocks in the price to free cash flow basket. It's going to be a little more difficult because we do have 791 stocks. Okay. So what we're going to do here, all right, first we have to sort them out, valuation. We want to sort them out by low price to free cash flow. All right. First of all, you saw NVIDIA? Y'all saw that? NVIDIA is number, all right, 791 because they were sorting out by the highest. So NVIDIA is last. So we're going to go over here. We're going to write that down. All right. Let's go ahead and write that down real quick. So we already know where NVIDIA is. NVIDIA is 791. You'll see how this works in a few seconds. So this is what you need to do right here. This is exactly what you need to do. You need to actually figure out where each of these companies rank. Now, in a lot of cases, what I would usually do is I would go ahead and I would I would continue to filter them out until I got less companies. But I wanted to start with our base filter because what did I say to you guys earlier? Typically you're going to end up with you're gonna end up screening the entirety of the market this way. All right. So we just kind of just browsing through here, like just browsing through, seeing if any of the ones that we can. I can assure you, the first one we find here is going to be, probably the best of the bunch or close to it. All right. You'll see how this works in a few seconds. All right. We're just gonna scan on through. Right. We got 40 pages here, so we're not gonna waste much time trying to be, like we're not gonna waste much time here trying to, scan for perfection, right? Eventually, what I end up doing is I end up finding, all the ones here that we can find, and then we kind of scan through it from there. All right. So notice how none of the companies that were on that first page for return on invested capital are in these first few pages here for low price to free cash flow. All right, so that says that they generated a decent return, but they're not really cheap. All right, they generate a decent return, but they're not really, the cheapest stocks here. All right, so I'm already a quarter of the way through the names almost here. Like I said, I'm not scanning for perfection. I know which names I'm looking for, so um, we will get there. Look at Lear again, guys. Y'all see Lear? Lear is in the building. So again, we have a group of companies here that have generated a decent return, but they're not too cheap in terms of the price of free cash flow. Right? But I want to know where we start to see them popping up. That's what I want to know. Right? Where do we start to see them popping up into the price to free cash flow basket? Where does that start off at? Look at Kinross Gold right there. And I wonder how expensive are these guys really in reality to everything else. Will any of them land in the growth at a reasonable price basket? Because that would be really, really good. It was amazing to see Nvidia ranked the worst price to free cash flow in the entire market. Wasn't that interesting, yo? Thought that was pretty interesting. All right. We are certainly just running into Nvidia like there's no need to really think about what's going on here. Nvidia is going to grow forever, right? But I've seen that time and time again. I saw the same thing with Tesla when Tesla was the topic of conversation. Right? I saw the same thing with them. We're starting to get out of the value basket and into the um into the growth basket now. So these guys on are starting to get on the expensive side.
Stephen,
Yes, ma'am.
you scrolled past BK Energy.
I did
You did.
on that last page. Oh, I see them right there. 350. Jeez, Lord. So BKNG at 350. Let's see. So BKNG is actually then that's going to be the probably the cheapest one on the page. 350, right? Yeah, 350. Thank you. Mm-mm-mm. Mm,
You're not correct. You got the last two on the page is, I mean, on the list are the same.
say that again.
The last one list, what was it? NEDP.
Gosh, yeah, I got it. Thank you. Oh, you know what? They're. I see what they're doing. I'm typing it in their. All right, there we go. I hit delete on it. Thank you. See that? Teamwork make the dream work. I see ResMed there just now. Did y'all see ResMed?
I saw Starbucks.
Oh yeah, they was like a couple pages back. They was all the way up there. But they cheap. But I didn't see them on that list of best returns. ADP actually at 440 was at number 20 on that first list, by the way. But I mean, as you can see, they're at number 20, so they're not going to make the cut anyway, right? Jeez Louise. How expensive are these guys? Oh, wait. No, that's WMS, not WMA. Oh, these guys are just sheesh. CBQ.
MEDP right there.
Oh, I see it, 463. Thank you. Good eye. 463. Looking at that.
I think it costs TIS 4 pages back.
Why you ain't seen that 4 pages back? Cecily, get your people. Get your people. Let me see.
Find my mic.
416. I got it. Thank you.
With that, Otis.
Yeah. 416. We ain't gonna say nothing. We gonna let this one slide, Doreen. We're gonna let this one slide. You know. Because Cecily has done worse in her tenure here. You know. Oh, goodness. So we got Otis, we got Booking, we got Nvidia, we got MedP. She said, I think you passed Otis 4 pages back. You know, I said I was gonna let it go, right? My bad, my bad. What you say, Cecily? She said huh?
They should think that would be not nice.
No, we appreciate it. We appreciate it. You know what I'm saying? All right, let's see here. All right. Hmm. I see Lamar popping up, so we might get MANH in a few. We'll see. Nope. Man. Oh, there goes M. Oh, did I just say it? Look, how did I know that? Right? You got. If you know, you know. MANH. There they go, right there. 581. Hmm. It's amazing how high these guys are sitting up on the there goes MasterCard MA right there. 593. Look, I finally caught one, Cecily. That's only my third one. Y'all caught all the rest of them. Oh, 593. All right, let's keep going. Look at JB Hunt. Celsius is getting a little expensive, Anisha. They're getting a little expensive out here. Look, they got MWA. We're looking for WMA. Jeez Lord. Are these guys expensive or what? I don't know what people say. I don't know what I'm gonna do. Yeah, give them a good life, blue, and I will do it. No, we don't have WINA. Or is it, I thought it was WN. It was WINA or WMA.
Anisha?
Let me double check. Hold on. Where is it at on this page? Or the one before that? We see WINA.
Was near the top of whatever page. Let's keep going back and forth here. Um, it was there. No. Your name was 697, wasn't it? 697? Okay, look for that.
697. Okay, hold on. Let me see something real quick. Hold on. I thought it was WMA. Is WINA?
I wrote WINA.
Hmm.
That's right.
No, it doesn't matter. I can check it real quick. Hold on.
So you know it's not.
Oh, it's WINA. I'm over here looking for WMA the whole time. 697? You sure?
That's what Alicia says. I believe her.
697. 697 WINA. Got it. See that? Team of work can make a dream of work. All right, 697. What y'all doing? Snapshotting the screen? Y'all ain't slick. Now I know y'all trick. I found it. I figured it out.
Snapshotting anything, but I have it on
Nah, Doreen gave it away. Doreen gave it away.
Doreen snapshotted it.
Y'all over here back checking. No, so I'm back testing. I meant to say, see, they back testing. All right, we got WINA. I did MA, right? Hold on. Yep, I did MA already. Looking for Apple, UI, and Fortinet, guys. Three more. Apple, UI, and Fortinet. Apple is 719. And then we have UI and Fortinet left. Maybe we passed UI already. What y'all think? Hmm. Nope, there it is. UI
And 771 was 49.
771. All right, so 771 for Fortinet.
And what was UI?
742, I believe. No, 782. I meant to say 784. Okay, so here's how this works. Okay, so now we have to give them their score. And so how he did it was pretty simple. All right, he said, okay, cool. I'm going to add up the score for each one of these companies, and whichever company scores the lowest um, is actually the best. Okay, a little reverse psychology, isn't it? Equals this plus this. All right, boom. All right, let's move this out of the way. We're just gonna sort them out. Delete that. Sort A to Z. Okay. So, surprisingly so, notice number 10 was Med P before we actually figured out what their value was, right? Notice Fortinet was number 2 before we figured out what their value was. See that? WINA was number 1 until we found out what their value was. So now if we was to sort them out, we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Okay? So now this is the current order of things here. And so what I usually do, if I'm taking this particular route, is now I want to analyze these companies and figure out whether or not they have the investment grade, right? Do they have the investment grade? Do they have the performance outlook? And how does that look on the companies? All right, so let's go ahead and insert a row above here. All right, grade, outlook. All right, pretty simple here. So, shall we? Y'all want to do a little digging? Y'all want to dig further? So the next thing we do, go to our analysis tool. All right, let's start with booking.com. So this is where Joel Greenblatt, most of the times, this is where it ends with him. So when he does this analysis, he would do it for all of those stocks, every single one of those stocks. And then whoever ended up at the top of the list, those would be the ones that he invested in, the top 30 of them. Okay? That's who he would invest in. He would invest in the top 30 by this ranking right here. And I can guarantee you, it's very possible that there are 29 companies or 30 companies who score lower than 797. And NVIDIA may not even be in the top 30. NVIDIA may not be an investment next year for Joel Greenblatt. All right? So it doesn't matter to him that NVIDIA is hot stuff right now. He doesn't care. He doesn't give two craps. All right? So we got a buyer with a positive outlook here. I see a NA on the price to book. So this may mean that booking is negative equity. That's quite possible. All right. And their price to free cash flow, as we already know, is not the best considering the consumer discretionary sector. So now we can see that when you dig a little bit deeper, it's not quite it for them. Okay, and their relative strength is really low as well. So, they do all right here. So they score a 7 here. They have a positive outlook. All right. Now, I think at least one of these companies is a real estate firm, so they don't get an investment grade. All right. It says what it is. But again, his system was not meant to. It's not meant to analyze it in that way. So what you could do, right, in the banking sector, and that's something that I plan on doing in this latest edition of the book, is replacing that price to book metric with analyzing where does that company rank among the top 10 largest banks, right? As opposed to doing, where's the company's price to book relative to what it usually is? Instead of that, I would say, where does the company rank in this way, magic formula wise? If I was to take the top 10 banks, JP Morgan, all those guys, and I put them on the same list and I added that company as number 11, for example, where would they rank? Right? Do they have a below average or above average grade? Right? That's and I would want them in maybe like the top 5. I'll let you guys know how I play all that out. Industrial, oldest world, hold, positive outlook. They score a 4, guys. They score a 4. I'm noticing price to book is coming up short again. Let's double check this really quickly just to make sure just make sure everything's on the up and up here. Let's go to the balance sheet. Yeah, shareholders' equity is certainly negative. So we're dealing with negative shareholders' equity. That's something that we really don't like to see on our end. But I had to double check that because that was 2 companies back to back that had negative equity. I'm actually going to note that here, right? Notes. Negative shareholders' equity. And we'll leave it at negative shareholders' equity for now. So these guys score 4. All right. What was that, a neutral outlook? Neutral outlook. And they have a negative shareholders' equity. So you see what we're doing now? Now we're filtering them out. Who's really the best here? Who's really the best? That's the question. All right, MANH. I think MANH is going to do a lot better than we think.
Why did you jump ahead? And Otis is positive outlook.
Positive outlook. All right.
Yeah. And then the next one is MEDP.
My eyesight is bad tonight.
We both don't have our contacts in this.
Don't hate.
All day, every day, all my life.
Mm-hmm. Little ponytail energy.
How dare you?
Matter of fact, in your case, we're gonna call that tiny dread. Tiny dread energy. Correct. We're gonna call that tiny dread energy. All right, 6 out of 6. Waiting on that to come through.
Wait, so you ran MANH anyway?
No, it was already in, so I let it run. Yeah, it was already running.
Sorry.
So hold with a favorable outlook. We don't have any projected growth rates here, but positive momentum. All right. So notes are notes, right? The notes are the notes. All right. Positive momentum and low debt. Is that fair enough? Positive momentum, low debt. So hold. What was that? I'm sorry. Hold on. Was that a 5?
No, it's all favorable.
Yeah. Well, I'm putting the numbers instead of the 5. Favorable outlook. I'm putting the numbers so that way we can actually see it, stacked up against each other, right?
Okay.
So they have strong relative strength and low debt. So MANH. This let's go ahead and highlight this one here. So far, this is the one. So far, let's highlight that. Okay, let's go MEDP. Okay, now this is a hold, so it's not something that we're going to just run in and jump into an investment. All right, but we're trying to decide right now who would we want to know more about. Does that make sense to y'all? Right now, we're just trying to make sure we don't waste too much time reading through quantitative reports and balance sheets and earnings tones and news crawlers and red flag reports. We're not reading everything about every one of these guys. We want to read about the ones who actually deserve it. So again, while we're waiting on this to finish up here, how does the magic formula system work? You have a group of stocks, right? You sort them out by price to free cash flow, and then you look at the ranking for every company for price to free cash flow. Then you sort them out by return on invested capital, and you look at their ranking for return on invested capital. You add their ranking together from both, and that tells you how the company ranks against everybody else. So the company with the lowest ranking is considered to be the best of the bunch. Strong buy, exceptional outlook, right? Great relative strength, low debt, right? High free cash flow yield, right? So great relative strength, low debt, high free cash flow yield. You love that. Sorry. Was that an 8 or a 9? 8. So great relative strength. Talk to me, Christopher.
How did you get that number to 8? Great.
That's their investment grade.
Oh, it's on your bags.
Yeah, it's right here. See right here.
See it. I'm looking at this. Spreadsheet. Okay.
But you still got the spread. Wait, you still got the spreadsheet?
Now look at the spreadsheet that you just, you switch. It's
Oh, okay. I'm about to say.
Oh, I mean that's kind of small.
No. When you said you're looking at the spreadsheet, I thought you meant like you was literally looking at the like, basically we don't use the spreadsheet version anymore. We use the application version.
Oh, okay. No, that's the spreadsheet. I'm talking about what you got up right now.
Okay, gotcha. There are some people, Christopher, who always, looking at the old version. We ain't calling no names though, you feel me? But they always want to look at the old version, man, It'd be like that. Be like that. We ain't call no names. We didn't call it any names. Okay, so these two so far are the ones. And MedP, we certainly want to read more about MedP right now. All right. Y'all starting to get the picture now? We're gonna do WINA. I don't think there's a I'm gonna do MasterCard first. Let's see if MasterCard gives us the proper readings here. Because sometimes these credit companies should be read more like banks, and sometimes they should be read more like um, normal businesses. Like Capital One, you can do that like a normal business a lot of times. I'm sorry, not like a bank a lot of times, not a normal business. Um, let's see here. Anybody have any questions while I'm filling out the rest of this here? Any questions coming to your mind? So if I ask somebody to tell me how to rank stocks in the system, y'all can tell me then, huh? Let me see. Let me see who's it gonna be tonight. You know, I'm thinking we're looking for Kenneth tonight, Cecily. What you think?
Oh,
So Kenneth, can you tell us how do we rank stocks in the magic formula system? What are the two criteria we're ranking them as, and how are we doing the ranking? Help us out here, brother. You gotta represent. You represent Team No Sleep now, so don't. All right, let's see. And he ain't there. He ain't there. That's all. He just ain't there. So buy with a positive outlook. That means it falls on you, Cecily. You know, you recommended him.
you
Hey. You agreed with the recommendation, didn't you?
return on invested capital first.
What? No, you're supposed to give me the process. How does it work?
Well, we did our screener.
Mm-hmm.
Okay. Then we go to once you've got those parameters in, you go to I believe it was the evaluation tab and sort by return on invested capital, high to low. Is that
Mm-hmm.
what you're asking for?
Mm-hmm.
Once you have that, now we are going to screen by price to free cash flow and get their ranking.
Okay.
Then once you have that, you need to get their final order. So you're going to add the ROIC ranking plus the price to free cash flow ranking. That's the final order that we are working through now.
Okay. Excellent. Appreciate it. Mm-hmm. It's just that simple, guys. And like I said, for this filter that we originally did, you can knock this down to a lot fewer, like a much fewer stocks if you wanted to, right? You can say, show me companies that institutions are actually buying right now. Institutional transactions, positive. Boom, we're down to 368. All right. You could say, show me companies with a quick ratio over 0.5. Boom, we're down to 243. You show price to earnings growth under 3. Boom, we're down to 192. Let's go with insiders buying as well. Boom, we're down to 22 companies. And now you just have to rank these guys right here. All right. So you can always boil it down to fewer companies whenever you feel like that, There's nothing wrong with that. But know that you're gonna, have less companies there. Now, another thing that you can do, let's get rid of these here. Another thing that you can do is you can actually say, you know what, I want to look at stocks in consumer defensive. Boom, I got 34 stocks there. See what I'm saying? So you can do it like that. And this is actually my preferred method right here. I prefer to do this. Pick a sector and go like that. That's what I prefer to do. But, that's not what we're doing today because we're just kind of, a proof of concept today. Hold positive for positive outlook. How about I just write it like that? Just a no. Apple. They got negative equity. I'm just gonna write it down. So we're just about done here. We got 3 more companies after this. It takes about 1 minute for every company. So, have no fear. We're almost there. Having no fear. We're almost there. Have no fear. We're almost there. A little ponytail energy. Get up out of here. That's my bars for 2026, Cecily.
Mm.
Can you dig it?
Yeah, but you forgot to add Tino the Yorkie.
Mm-mm. Tino got a little ponytail energy, man. Mm-hmm. All right, Apple's a buy with a favorable outlook. That's a 6 favorable. Great relative strength. Low debt. High F score. So let's go buy favorable. A 6 favorable. F score 8 high relative strength. Okay. So far, 3 out of 7 are the ones we really want to look at. And so we will look at them in this order. In the order from top to bottom. MedP, MANH, Apple, and then whoever else on the list. Okay. I got to start only talking when something's already typed in. We're running out of time.
That should be one. 49.
We're gonna find out. Nah, we already know they're good, right? That's the other beautiful part about having already done research, Alicia. Right? Like if you're a person that's been doing a lot of research on a regular basis, that helps you out here. It would have helped out a lot more if Fortinet was ranked at the top of the list. Then we know definitively, right? I can set this list aside and go buy Fortinet and come back tomorrow. You know what I mean? Look at that little bit of recovery happening there. Look at that right off of that key level we had there. Beautiful. But they got to get back above that that 20 MA on the hourly chart, or we not having it. Hold positive outlook. Heard that, Alicia? They're a hold with a positive outlook. They're not that great. Price to book is,
Right.
huh?
So I see that.
Yeah, that price to book, that's what happened. Look at that price to book. It went up. That price to book was not that high before. Oh, that's right. No. That's what happened. No, remember, Fortinet been running. So it basically knocked them out of valuation territory. So actually, so Fortinet is actually a great example of what we're discussing right now. Because when we found them, they were a great candidate. And now they're exploding to the upside, 80 on the RSI, right? So Fortinet is a prime example of the system that actually, Fortinet is a prime example that the system actually works. Let me show you guys something. And we already own Fortinet. Here's what they look like of the most recent past few days. All right. This is what Fortinet looks like over the past. This is what Fortinet looks like over the past couple of weeks. Boom. That's Fortinet over the past couple of weeks, guys. Okay. That's a weekly chart, guys. I repeat, that is a weekly chart. Those aren't days. Those are weeks to the upside. They went from $90, $80, I'm sorry, to 146. They almost doubled in price over 1, 2, 3, 4, 5, 6, 7 weeks. How were they found? Using the system that we're discussing right now, using this system right here. Using this system right here. Beautiful stuff. Okay, now let's talk about it. A whole positive, that's a 5 with a positive. Extremely high valuations and low F score. So 5 positive. But isn't that amazing though? Because this also shows you how our system automatically adjusts when a stock has already given the gains. So our system says, no, just keep your eyes on that return on invested capital for now. That's what our system says. Take your profits, keep the eyes on the return on invested capital. That's what our system would demand that you do right now. We're not investing, we're not buying more right now. Right? Fortinet has to come down and give us a better price. Right? We need a reasonable price for Fortinet, or we're not touching it at all.
Except to take profit.
Except to take profit. What's up, Dana, Drew, Rose, Totem, SIQ, Noted? What's up, Prince Blanc? What's up, Faith, Brooklyn, Fibs? What's up, Yolanda? Got to say what's up to everybody. Kitten, Kimani, Dante, JM, A, Natalie, Yuko, Ramo, Rejoice, Javad, Koga, Sam, Jimmy. What's going on, guys? Hola, hola. All right, Ubiquity. That's quite a name, isn't it? Ubiquity. One of them small ponytail names, Cecily. Um, it's a 6 with a favorable, a buy. Huh. It's got great relative strength, low debt.
Technology.
Hmm.
It's in the tech.
Not bad.
Mhm. They're still undervalued somewhat anyway, right?
Mm-hmm. Relative strength and high valuation. I'm sorry, not high valuations. I'm about to say low debt. And last but not least is NVIDIA. Now, let's go ahead and mark this one because we're going to look at this one too. So now the 10 names that we collected so far, 1, 2, 3, 4, and I don't think NVIDIA is going to make the list. I don't. They're actually fairly valued right about now, Alicia, because remember the fundamental value is below your street value. So for Ubiquity, we have to go with fair value at 550.94. But isn't that amazing? Look where they are right now.
Yeah.
And so they should be on their way down, or they probably just bounced off of our level. It's quite possible. Let's pull them up real quick. Let's see UI, right? Oh, wait. I said UI, not NU. What's going on? Whose man's is this? 560. So yeah, so they're on the way down to our level. Isn't that amazing? So they were at $1,100 and they fell all the way down to our target at 576. That's okay, y'all. So Nvidia is actually still a buy favorable, and of course trading below. So yeah, Nvidia is actually going to make the list. What was that? 6, 7 favorable. All right, buy. Great relative strength, low debt, low price earnings growth. So if I had to do some research and find out who I want to buy, these are the 5 names here. I can actually now eliminate these guys here, these guys here, 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 here. I can get rid of these guys here. Oh, hold on, sorry. I can get rid of those guys, and these are my people right here. These are the ones that I want to dig into in this order: MedP, MANH, Apple, UI, NVIDIA. Okay? I've used the power of our system. I've filtered out the market. I've screened the stocks. I've given you 5 names to choose from. Keep in mind, the market is a bit stretched right now, but these particular stocks right here give us the best opportunity to continue to earn if the market continues to rise. Everybody got that? Go ahead and snapshot your screen. Snapshot your screen. Again, these are the guys you want to learn more about if you don't already know about them. No ticker symbols tonight, Jay Crispy. No ticker symbols tonight. Save that for the morning. So what do y'all think about our systems here? Now, I want to point out that MedP and NVIDIA have the highest grades here. All right. But nonetheless, you want to do your due diligence and dig into these particular companies, right? Here they are. Again, I'm giving you a chance to go and snapshot them. All right. These are the names. All good, all good. Does anybody have any questions before we close out? I'll be closing on about 5 minutes here, but I got time for some more questions if you guys have them.
When's this one gonna get uploaded to YouTube?
This one will be uploaded to YouTube probably on Thursday.
Okay.
I have the other one already uploaded. No, not Thursday or Friday.
Okay.
Have the other one already uploaded right here. I'm gonna grab it for you right now.
So I got an alert.
Oh, you got an alert that the other one was uploaded?
Yeah, I don't know which one it was. Just alert just came on my phone.
That's the first one. That's the Value Investing 101, the Introduction to Value Investing.
Oh, okay.
So for those that want to keep up with these uploads, you click the link at the top of the room on Clubhouse. You will see a YouTube channel in there. You see, it says subscribe to YouTube. Check us out over there. If you happen to be on the Twitch right now, I got you. Don't worry, I got your back. I got your back. All right, as you can see here. So if you check us out, what's up, Morpheus? What's going on, man? What's up, June? What's going on, folks? So you see right there, I put the link in the Twitch channel as well. It's in the Twitch chat as well. If you click on that link right there, you'll see it says subscribe on YouTube. All right here. Also, if you want to learn some of the tactics that we talked about tonight as far as investing, you'll also see a book there called The Playbook for Stock Investing. I've been told it's a pretty good read. So far, it's got all 5-star reviews. I actually managed to spend at least one single sad, lonely day above the intelligent investor. But we made it nonetheless. We made it. We for one day, this book was the number one book in portfolio management. Get you a copy of this book, man. You want a copy of this book? I promise you that. Okay. If you're looking for that stock analysis tool that we were talking about, right here you see it says stock analysis tool. You click right here, and you'll be able to download the stock analysis tool that I was using tonight. This tool right here. All right. So everything you need from us is in that link in bio. So save it if you have to, whatever you got to do. But most certainly you want to make sure that you are, diving into that thing there. As of right now, it looks like, after that first hour in the market, we're starting to pull back a little bit. Tiny pullback, nothing to write home to mom about just yet. But I'm going to be watching in the overnight session. If overnight we happen to hit, if overnight we happen to hit the 20 MA, we close above the 20 MA overnight, I will go ahead and open up another long triple Q position to see if we can at least get back towards those highs yet again. This very same area of the market was the last area to bring us to those highs. So, if we close above the 20, I can't assume that we're not headed there. All right. So we're probably going to be, let's say from here to here. That's about a 1% gain. Perfect. Absolutely perfect. So, a little break of that high, right, should be good enough to get me the 3% I'm looking for on my 3x leverage ETF, the T triple Q. Pay close attention. I'm trying to show you how to just extract tiny multiples out of the market, little pieces at a time. All right. Anyways, I guess we will meet again tomorrow, in which case we will be talking about a totally different topic, in which I will put in the schedule for you guys tonight. I was going to do the Petrosky F score, but I think the magic formula was going to be the main one we discussed. I'm probably not going to do the Petrosky F score tomorrow night. I'm gonna see what else I have in my agenda. We might do it. We'll see. Right. Because tonight I think was the most important one. The magic formula is the most important one. This ranking system right here is the most important. And I am going to think about rating. I am going to think about taking this particular system and ranking it. For you guys. With in the second edition of the book, I'm going to think about writing this into that so that way it can illustrate how you go about doing this, but putting it in writing for you guys that you guys can look back on, right? Anyways, other than that, guys, I guess we will link up tomorrow. Everybody be blessed, stay well, and I'll talk to you soon. Later.
Thank you so much.